from different areas of the 757 that are here. My name is Victoria Bailey, and I am with Keller Williams Allegiance, and I am the team leader of the Empire Home Teams. And beside me is my buyer's agent, Shakira, who's with us as well. So everyone's just gonna go around and introduce themselves, and then we'll go from there.
I am Jared Hunt. I am a mortgage consultant at Dolphin Home Loans in Virginia Beach. As Sariva said as well, I am here to build a relationship with my clients and achieve the dream of owning a home. So, Jared Hunt at Dolphin Home Loans.
Hi, my name is Sariva Manuel. I am with Homespire Mortgage. I am a senior mortgage loan officer. I've been in the business for several years. My goal is to help people achieve home ownership, as well as if you own a home, help you assist in refinancing to get a lower interest rate.
My name is Brittany. I'm an account executive with Goosehead Insurance, which is a local broker in the area. We have 20 to 30 different options for insuring your house. I can insure any home in Virginia and then also licensed in the state of North Carolina. And I look forward to working with you.
Hi, I am Shakira Grant. I'm a realtor here in Hampton Roads area, servicing all buyers and sellers, and I'm also the buying agent with Empire Home Team. So we are here to help inspire you and empower you to purchase or sell your home.
Hi, my name is Victoria Bailey. I am with Keller Williams Empower Home Team. Shakira, like she said, is my buyer's agent, and we are here to empower you and educate you through your home ownership journey. So if you guys have any questions, please reach out, and we'll talk to you guys soon.
Hey, my name is Dejan Briggs. Most people call me Briggs. I own an insurance and financial services agency in the city of Hampton. Our goal is to help our clients succeed with money, and one of the many ways that we do that is through protecting your assets, such as your home. So I look forward to sharing with you all and to partnering with you in the future.
We are going to start our conversations off with talking just about how you can assist and how we work across the lanes, right? So we have insurance brokers, insurance agents, we have mortgage brokers, mortgage agents. So one of the things I want you guys to explain is, what is the difference between the two, right? How can you help each other and benefit like that across the board? So yeah, so we'll start with Miss Brittany. So what's the difference between an insurance broker and an insurance agent?
Well, so technically I am an insurance agent, but as a
Right.
broker, you have multiple options. So 20 to 30 different companies we can find to insure your house. We have, we can go with the most competitive price. We can go with, any type of property, any type of like coastal property, home, mobile, manufactured home, any type of home, we can find a product to insure the home for. So that's kind of an advantage with the broker, is we have multiple options, multiple pricing, finding what best suits the client.
That's amazing. It's awesome because it really does need to be done, right? Working between the two. Another question that I have for you, Mr. Briggs, is how does that help you, right? Working in your insurance firm, how does that work? You having a partner across the way. How can you guys work together?
Yeah, so that's a great question. So with State Farm, we're the country's #1 insurance agency, so our strength is in our finances. So if you have a claim, we're generally able to pay out at a faster rate. However, there are some areas where we may be a little more conservative, right? Which, as she talked about, if you're closer to the water, we may not cover that particular area or your home. So we generally go to our insurance broker partners and refer business that way. And so it's a duality kind of thing, right? So, yeah.
Yeah, I think that's really important to know and to have, because so many times we'll get asked the question so what's the difference in between this and what's the difference in between that? And when we're working with people, they really don't know. They don't know. They don't do this on a daily basis. So to flip to the other side of the sofa, we have our mortgage broker and our mortgage lender. How do you guys work together in helping your clients, if not having just to share files? Because sometimes you guys can share credit reports and stuff, right, to help the clients, or no?
Not supposed to share a credit report. You will get new credit pulled at a new company, but if a client is shopping for a lender or a broker that they want to use, by getting your credit pulled multiple times within a 45-day period, it will not hit that client's credit with a hard hit, as long as it's within 45 days of each pull. Now, when it comes to the differences between us two, obviously we both have the same goal of being able to get people in their homes, but on her side, she might have some loan programs and have some benefits that she can provide her clients that I can't, and then vice versa. I'm not sure exactly what loan programs she does have, but different loan programs on her side might be such as, do you do VHDA loan programs?
Yes.
VHDA, and in the broker world we do not. So just an example of what the difference could be between both. But
That's important to know.
as she said in insurance, I work directly with lenders, so I am the person who is actually locking that interest rate I'm working directly with. And then I'll let her explain her side of how her processes go within the company.
So, to answer your question, the differences, that's what we're explaining. Like you stated, he is a mortgage broker, so typically brokers shop around with different mortgage companies, where I sell loans to one specific company. So he has a better advantage as far as if one company can't offer this interest rate, then he has the ability to shop and look for another company with a lower interest rate. I like my side better because we do offer different down payment assistance programs for first-time home buyers, whereas brokers may not have that. They don't offer those type of programs. So I deal primarily with first-time home buyers. I'll say 98% of my business is purchases, and I deal with a lot of first-time home buyers. Therefore, a lot of them unfortunately don't have their down payment, and I am able to assist them in that area.
That's awesome.
And knowing that, like, you know, we'll always get people who, like, they don't always have the money. Like, I think that's one of the biggest things right now, right? People don't always have the money, so, like, what do we do? What do we go? And
And to further touch on that too,
Yeah.
Victoria, not only do they not have the money, because right now it is a seller's market still,
Yeah.
although we are seeing some of the sellers pay more of the closing costs, but we still have a lot of sellers that aren't. So now buyers have to worry about they have to worry about the closing costs as well as the down payment. A lot of clients don't have both, unfortunately. So if they have saved up money for down payment, then they don't have that extra 3.5% for closing costs. So that's where my program actually benefits, because it's taking away the pressure of both and then leaving the pressure of possibly one if the seller is not going to cover that closing cost.
And in a VHDA loan program, you don't have to pay back that assistance, correct?
Well, there are two separate options. So one, you are actually paying it back. It's 100% financing. The second option is a true gift. They're giving you a portion of your down payment in the form of a gift, and you never have to pay it back.
Which is awesome.
Yes.
But like she said, in a market where because we are expecting it to turn back into a buyer's market,
Absolutely.
somebody has the option to actually receive 3% from a seller. It'll definitely help them a lot and alleviate those, I call it cash to close amount
Hey.
they have to bring. So
I know when we bought our first house, my husband and I, like, that seller paying, like, our closing costs, and it was new construction, we were like, yes. You know what I'm saying? Like, it was like a win-win all around. So, like, that's really, you know, it's still there. It's still very much there. So, Miss Shakira, what else do we have on the agenda? I'm excited.
So we do have some questions. We have asked some people that we know, first-time home buyers or homeowners, that have gathered some questions for lenders and insurance and realtors.
Yep.
So the first question, which is a general question, just to kind of set the tone. What is the process of buying a home? When do we all fall into that place?
That's a
So I
good
guess we'll start with Victoria. So you kind of outline how the buying process works, and then, you know, you guys can elaborate when you guys step in and how you guys help our buyers get to close.
So it really does take a team. So, like, right, so when we're working with a buyer, we're working with someone, it takes every single person that's sitting on the sofas and the chairs. We all have to work together in that. The first part would be talking to your lender, right? Seeing how much you can truly afford. So either speaking with Jared or Mr. Riva and saying, hey, like, what can you afford? What can you do? Where are our perimeters? And then after we find your house, you'll come back either to me or Shakira. We'll go out house shopping. We'll write your contract. We'll get you into a house, right? And then we'll send your contract package over to our mortgage servicers and loan officers, and they then at a certain point will start talking to your insurance agents, right, who will start pulling the numbers and looking at how much the house needs to be insured for. There's this thing called a declaration page for short terms. We normally call it the deck page, and to make sure that the insurance agents send it over to the lenders, so therefore that can get paid. So a lot of times it's really in the midst, and even in sometimes writing your contracts, even before we write that offer, just getting in contact with your loan officer and your insurance agent is going to help, because it may be that house's insurance is so high, right, that this isn't the one for you because it's going to take your numbers completely out. So to answer your question, it's really a mix of what does the client need, what does the client want, when we're going to do it. Also, what does that property look like? I had a client buying a house with a pool, right? And it was in an AE flood zone. And we were like, what is the insurance on this bad boy, right? Because we got a pool, right? The pool actually did have a fence around it, so that makes a difference, right? In insuring that property. And it was in the AE flood zone. So those flood zones, which I know are changed and stuff like that, make a difference. And recently what I've noticed is that, so just like lenders have like credit scores, insurance agents have insurance scores, which is incredibly important, because if that insurance score that buyer has, let's say their past house, they pulled insurance claims like crazy, their insurance rate is actually like a lot higher. And so like knowing that up front knows, okay, well, maybe their pre-approval can't be as high. We need to just scale everything back some. So it's really about, for us, it's like having that conversation, knowing where they're at, but then also talking to their loan partners. What does their finances look like? Do they have the money? Can they do a down payment? Can they, do I need to go in and negotiate some money from there? And most of the time, before I even write the contract, I'll contact the insurance agent. Hey, can you pull a quicker on this house? Because also the house has a lingering report, right, with it. If that house has had a ton of hurricane pulls or just claims on it, it can make things,
Water claims.
like, it drives things up. So
Flood insurance add $100 to your monthly payment.
yeah.
I know a lot of times when I speak to people, I'll say, like, if I want to pre-qualify them, I'll say, well, what range are you shopping for? Are you shopping in? And what is your comfortable monthly payment? Because they're like, oh, I want to buy it $300,000, but they want their monthly payment to be, oh, I'd like it to be at $1,100 a month. It's like, and that might not fit into their budget. So
Right,
yeah,
right.
if you want your payment to be within $1,200 a month, then I can pre-qualify you. You do qualify for $300,000, but if you can't afford a monthly payment of $1,200, $1,300 a month, then
Right.
just keep that in mind while you're shopping.
So I do have a question with that you said, which is great, because like Victoria said, in the home buying process, typically the next thing you would do once you pick your realtor is go get your pre-approval, so we know what price range we're working in, where we're going to start working, because we definitely don't want to show you a house you're not qualified for, because we don't want to break any hearts.
Right.
But when they
It
first
happens.
do come to you guys, what is the steps, or typically how does that process work? Like, what do they need to bring? How does the process typically work when you first meet your clients? I think a lot of people are wondering, where do they start, or what questions they should ask for lenders when they are shopping for a lender. So if you guys can elaborate on that, that'd be great.
Well, my steps. Obviously, I want to call my client, introduce myself. First things first, we need to get an application. I can take applications over the phone, or we can do applications online. If you do your application online, typically I will call you. I will have questions. Not all of those online applications will get all of the information that I need, or I might have questions about the information that you provided. I typically, just to be honest with you guys, will run credit immediately, because credit's not where we want it to be. I'm not going to ask that client to supply me with supporting documentation if our credit is not where it needs to be yet. Of course, in any situation that credit is not there, we are able to look at the credit report and maybe give some advice on exactly how we can get your credit to where it needs to be to purchase a home. Once we are past that application point, I have all the information from you that I need. I will be requesting documents to support the income and assets that you have stated on your application. And it's a responsible practice as a mortgage lender to have supporting documentation to support your stated income, because especially with self-employed borrowers, you know, that self-employed borrower might state that they make $10,000 a month, but guess what? That underwriter is going to calculate qualifying income based off of previous year of tax returns, and if they had a loss on that tax return from the previous year, maybe they didn't make as much last year, but they're making more this year. They're going to count those tax returns and any type of losses that are on those tax returns for the previous years as qualifying income. So it's responsible for myself as the mortgage lender to have supporting documentation. So my advice on someone that has filled out an application is to start collecting documents, your pay stubs, your W-2s, pay stubs for a 30-day period, your W-2s for the previous 2 years, tax returns for previous 2 years. Some loan programs require them, some loan programs don't. Everything's different. We have what's called an automatic underwriting system that will tell you exactly what documentation that we need and what the underwriter is going to underwrite the file with. So small things like that.
So Reva, you want to piggyback any information on that?
Yeah, sure. So, excuse me. My process is fairly similar. My preferred method for applications is online, only because once you apply online, it allows you to upload your documents in a secure portal, which many clients prefer. I would need at least one pay stub, your last 2 years W-2s. I only need tax returns if you're self-employed, so your income documents, your asset documentation, and I actually request that regardless of your credit because I want a full picture. So if for whatever reason your credit score isn't where it needs to be, I'm going to tell you what needs to be done to get your credit score there, but I also want to know what you are going to qualify for once your credit is up to par. So I look at the full income and asset portfolio just to make sure. I let you know what the sales price range will be once your credit is actually up to where we need it to be. The credit score requirement that I have is 600 for FHA loans, but VHDA, the down payment assistance company, they require 620. So therefore, if you need down payment assistance, you need to be at a minimum of 620.
Perfect. Great info. So switching over, that's
Wait,
great, right?
I'm sorry, one last thing too, I'm sorry. Now, I am also in agreement with the income verification, not just with self-employed. Many people, for example, right, you're laughing. So they'll say they make a certain amount of money. They'll tell me what their hourly rate is. However, they're not considering that they may not work 40 hours every week. So if you're not working 40 hours consistently, even though you may consider yourself full-time, we have to go by what your year-to-date wages are, which could be lower than what your actually hour wage is, which is going to lower our qualifying income. So it is imperative that we collect all that documentation up front so that we have an accurate picture. The last thing we want is for you to start shopping and you actually don't qualify for that house.
For the insurance side, we really did forget about you guys. So in the home buying process, what are some things that you would tell your clients when they are shopping around for insurance? So what kind of questions should they ask? What should they ask other insurance companies if they are shopping around? What does that process look like?
I think insurance is coverage, right? A lot of times we focus on price, but how much is the home actually being covered for? So at the end of the day, this is an asset, and understanding the difference between the market value and the rebuild value or the replacement cost. So I always explain it, the replacement cost is going to be how much, if your home is decimated, does the insurance provide you to rebuild it? And that can be very different than market value, because I can build a house in Hampton and the same house in Virginia Beach, because Virginia Beach has the ocean view, that house will actually have a higher market value. So I think the replacement cost is probably the biggest thing that you really want to be finding out on your insurance, and then your liabilities, especially if you're someone who you throw a lot of parties, you have a lot of family gatherings, someone gets injured, someone gets hurt, they decide they want to sue you, you know, how much coverage does your insurance have? And the last piece being jewelry. That's something people don't often think about. So how much jewelry do you have inside the home? Will you need a separate policy to cover your jewelry outside of your homeowner's insurance policy? So,
I never knew that. That's interesting.
It is.
That makes a lot of sense.
But you know what? You know what's funny? I don't mean to cut you off here, Brittany.
No, 'cause
But
I'm like dying to
I was
talk.
actually, I was helping the seller sell their house, standing on the deck. You wanna know what happened to the deck? It fell off the house. And at the time, the other agent that I had shadowing me, she was 6 months pregnant. And so like immediately I just like looked over and I was like, are you okay? Like,
Right.
I don't even care about myself, but
Right.
Oh my God.
like, are you okay? And so it was just very interesting. Like when the deck fell off, like the guy's eyes got so large because he was
Right.
just like,
Oh my gosh.
like I don't have insurance for this.
Right.
Like, yeah. So it was very interesting. Although the deck, it was close to the ground. It was maybe like 2 feet off the ground, but even still, when you're falling off a deck or it disconnects, that's just, I mean, that's good to know if someone's throwing parties and stuff like that.
Yeah. Coverages are so important.
Yeah.
So,
And yeah, I mean, Briggs kind of, you hit every main topic on the head there. Replacement costs and then extended dwelling replacement costs. Like right now, today, building a home would cost way more than it would have a year, even 2 years ago, because building price materials are so high. So we typically always like to insure it for an additional 25%. And in a scenario like that, you have enough money. If your house, you suffered a total loss, you would have enough to rebuild it to the way it was before you suffered the loss. Like deck, kind of just going into that, that's like kind of, you know, if it was detached from the actual house, that would be our coverage B on an insurance policy. So if you have like a shed, a nice fence, anything like nice pieces away from the house on the property, you want to make sure we provide and insure to protect those. If, you know, a storm comes through and your fence is ruined, you want to make sure you have enough coverage there. And then there's, you know, another important coverage, the water backup.
backup food, right?
Yeah, drains, sewage backs up in your home. As we all know, water can cause a lot of damage. So that's something I always put on every policy we
Yep.
write.
Same.
Depending on the size of the house and square footage, you might want to increase it. But I would say a minimum of 25,000. I'd say for the majority of homes that I insure.
And then the last thing as well, understanding your deductibles.
Yeah.
Right, so that's huge, understanding the deductibles, how much money you may have to come out of pocket for, or at what point the insurance company is going to step into the picture. So really understanding your deductibles, there's an inverse relationship between your deductibles and your premium, right? And so the higher your deductibles are, the lower your premium is going to be, which in turn is going to lower your mortgage. So if you can afford to have a little higher of a deductible, you can also positively impact your mortgage by reducing it in cost.
So I have a question for you guys, just to piggyback off what y'all said, and I think it's something very important. When you do the insurance replacement costs, right? So that costs us more this year than it is next year. So every year, like I know, like my insurance policy gets updated, and I get like a letter in the mail from my insurance company saying that this is your new insurance policy amount for the yearly amount and things like that. And then I'll get like another letter from my loan company saying this is your new mortgage amount, right? So how does that work as times change and those policies are reviewed? If the building costs went down next year, right? Because like right now we know a lot of things are inflated because of COVID, right? So if that cost went down next year, how does that work in their policy if they don't change that? Or does that change automatically?
I'll let you answer first because I answered first last time.
So it doesn't change automatically. I always like to inform clients that, you know, if you were to like put a pool in or add, you know, a brand new fence or anything like that, you would want to notify your insurance company to make sure you have enough coverage in place. But no, it's so when your policy renews, it's not looked at as like, okay, what has gone up in cost over the years? Will this house cost more to replace now than it did when you first got the policy in place? It's always good. The majority of us don't think about reviewing our insurance when it comes to auto, home, any of that, but it's always good, I'd say, to take a look at it and call your agent just to make sure that you are at the right levels of where you need to be insured every 6 months to a year, I'd say.
Yeah. For us, ours goes up probably about 2% a year,
Okay.
on average, just to keep up with inflation.
Okay.
We oftentimes, if you told us you put a new roof on the house or something of that nature, that'll give you a credit going back. If you have home security, that's going to give you a discount as well. So ours does kind of fluctuate with the cost of materials, but still having the review once a year is something that's really, really, I'd advocate for, because it does give us a more, as opposed, I always tell clients, like, instead of it being on autopilot, we're going to do 2% a year to keep up with inflation, right? And instead of it being on autopilot, we could kind of take and go from automatic to manual. So I can go in and I can right size some of the stuff is pretty much what we could do. So we have, I'm sure you guys have one too, a replacement tool, a replacement cost tool that says, hey, this is what you currently have. This is the material of what you currently have. This is the price for it right now. So we kind of take it off of that autopilot 2% increase and say, no, this is actually what it is. This is the current price. And so the policy review does help.
Yeah.
That's, you guys think I'm gonna review my policy and see what it is? Just because, like, I know, like, I'm just thinking about, like, I'm putting brand new, like, windows, like, throughout my entire house. I feel like I need to let my insurance company know that I'm putting in new windows. Two, if it changes my insurance costs, you know, like, that's important to know.
Because that will change your overall mortgage price.
Yes, and if it goes down, I'm not gonna complain.
So it's safe to say that, sometimes your insurance, if it changes, it can affect your mortgage rate.
I mean, like,
I have,
I'm sorry.
I'm sorry, I didn't mean to
I was
interrupt.
just going to piggyback on one thing that Briggs was saying about like the new roof. You're talking about new windows, but if you have buying a new home that just a new roof was put on, I mean that can drastically bring down insurance rates. That is like a big factor when it comes to shopping insurance and finding a good rate. So yeah, just kind of touching on that piece. I mean, it definitely can drive down rates. So something worth mentioning. And then we also have a couple of different carriers that offer new roof discounts. Homeowners of America is one, but if your roof has been replaced within the last 2 years on the house you're purchasing, I mean, it's a substantial discount. All we would need is like contractor name and a number, and we can apply that discount to get your rate down. And then, if we're having issues, with the lenders and DTI or tight margins, those things are well worth pursuing and looking into just to get down, your client's monthly mortgage payment as far as we can.
And while he's on this side, real quick, flood insurance. You said AE earlier, so I wanted to talk. AE means you're in like a mandatory flood zone.
Yes, because they're changing the flood, aren't they?
Yes, they are.
October
They are
1st,
changing. Yes,
as of
yeah.
October 1st.
So that's something to consider as well, right? Will you be in a flood zone? Will you have to have flood insurance? Because that plays a part. And flood insurance is different than your homeowner's insurance, which a lot of people seem not. They don't know, right?
they don't.
They don't understand that. And flood insurance, the first year, like FEMA, at least for us, FEMA receives the payment, right? So for flood insurance, it's pretty much a FEMA program, and the insurance agency is just holding that account for FEMA essentially. So FEMA comes up with the price and then all that stuff. The first payment does not come out of escrow. So a lot of people think, hey, my homeowner is going to come out of escrow. I don't have to pay anything up front on it. Where flood insurance, you do have to make that initial payment to FEMA, at least for us. Same thing, Dad?
Same.
And you guys no longer require an elevation certificate, is that correct?
On October 1st, yeah, it depends on.
Awesome.
Yeah.
That's great news. That's 350 that the borrower would save. I know that is a process that we've had to deal with in the past. The insurance person will tell me, do you have an elevation certificate? I'm like, I don't know. Because who has an elevation certificate? Honestly, I don't know. Maybe I just wouldn't think of that myself. It's something that I learned when I got into the business. But no longer requiring an elevation certificate is great. That means you guys can issue policies without that, right?
Yeah,
That's cool.
It helps the cost. So if you don't have an elevation certificate in times of old, I mean, your premium it's like outlandishly different. So you could do it without an elevation certificate. It's just going to cost you like an arm, your leg, your kidneys, and liver, to do it. So you can't do it. Right, your whole body. So the update is going to allow us to curtail that, and it's not 100%. It's not always you don't need the elevation certificate. There still are going to be circumstances, and it's a lot to learn. So I don't know all of the situations, but there are going to be instances where you could curtail that for sure. Yeah.
My question, it's just a general
Take it
question.
over,
It
Jerry.
doesn't have to be long. But if your insurance premium per year, your annual premium went down, when your old premium obviously expired, your mortgage servicing company would then be notified of your new premium amount?
Yeah.
Okay.
Yeah.
So if you stuck with the same insurance, your insurance premium happened to go down, they would automatically be notified by the insurance company that your premium has gone down. And then that would technically lower your monthly payment, whether it's by $10 or $50. I mean,
Go ahead. I'll let you answer that. I think you guys send out a check. So if escrow went down and you guys already overpaid or paid for the year in advance,
okay.
they get a check for the difference.
The difference,
That,
yes.
okay, that answers it.
That's right.
Because
Yeah.
we don't, our side is not necessarily servicing the loan. It's just getting the loan done. So once we're done with it, it gets serviced by the lender, the person, and then we don't have anything to do with it after that. So
So
the
can
servicing
you
company
elaborate
would,
on that? That's a question that people did ask. If that's basically someone selling the loan, is that correct?
Yes.
So-
And why is that done, or what is that process?
how mine is that the lender that I have chosen, that I've locked the interest rate through, would then service your loan for the life of the loan until it's refinanced or sold to somebody else. The lenders that I work with typically do not sell loans. I do know that some mortgage companies can work differently to where the actual the broker or the loan officer's company would execute the loan, and then they would sell that loan to a servicing company that would then service the loan for the life of the loan until it is refinanced.
When you have a mortgage company, you have mortgage servicers, and then you just have a mortgage loan company. My company does not service loans. So we get the loan closed, and then yes, we find someone who's actually going to service it and then sell it to that company. That's the way it works.
Okay. Now, sorry, go ahead.
No, I was just gonna say. I mean, it happens more than not, like 85% of the time. And a lot of times, like clients will be like, "Well, I don't want my loan sold off." Well, I'm sorry, you just don't have that option, right? And it sucks to tell them that they don't have that option. But my question is, so once that loan gets sold off, can they still call you and contact you about their loan? Because they always say that it changes, but can you just their interest rate and anything about their loan doesn't change unless their taxes or insurance changes, right?
Yeah,
Okay.
nothing changes with the loan.
The loan terms will remain the same, yes.
As long as you're in a rate lock.
Right.
You're not in an ARM, an adjustable
Oh,
rate
that
mortgage,
is right.
which
Which
are
is
not
cost you an
very.
arm.
People do ARM loans because at the very beginning you can purchase a expensive home, and at the beginning of your loan you can have a lower interest rate, lower monthly payment. Now, typically speaking, if someone did an ARM loan, say your rate was going to stay at 3.5%, for 4 years. After 4 years, your rate would adjust. They would refinance before that rate adjusted to get out of that ARM. So because adjustable rate mortgages, over time, the rate just keeps on going up. It has a max limit that it can go up legally. Each program would be different depending on what you chose. But typically speaking, anybody who's a first-time home buyer, or most of the loans, I'm not going to lie to you, I've never locked an ARM before, an adjustable rate mortgage. Have you ever done one before?
I haven't done that.
Yeah. All mine are 15 or 30 year rate term loans. I do know an example of why somebody would do an ARM. It's because they were buying an $800,000 house. Obviously, when you're purchasing a home that's over a specific price limit, it's called a jumbo loan. Jumbo loans are going to have higher interest rate pricing. So if you do an ARM, adjustable rate mortgage, you would choose your interest rate at that time, Over time, it can increase, but that person specifically that was buying the $800,000 house took the arm for the lower interest rate initially and then refinanced it into a rate term after that. So
Do shorter terms have better interest rates for you guys?
they do. Very good. I'm not going to say specifics because I have to disclose
Right.
specific APRs, and rates change every day specifically. They change from 8 a.m. in the morning, 10 a.m. in the morning to
Right.
2 o'clock in the afternoon. Literally, we get emails all day that say rates are on the rise or rates are dropping. So they're always different. But yes, 15-year mortgage, of course your monthly payment will be higher, but you will be able to capitalize on that lower interest rate at the beginning.
So I have a question. This is a popular question. What is equity in your home? And how does equity and refinancing, does that kind of coincide with each other? Why would someone want to refinance? And then also, what is the equity in their home means for them, for a homeowner? So, Samir, you want to talk about that? Okay.
Well, equity is your value in comparison to what you owe. So that difference between the value of your home versus your loan amount would be considered the equity that you have. Some people refinance to pull out that equity. You can pull out the equity to pay off debt. If you have some debt you want to take care of, if you want to do home renovations, some people refinance for that reason, or they may refinance for the reason, as he stated, they want just a better loan program altogether. Many of my clients, if we start off with FHA, they will eventually get out of that FHA loan and then go into a conventional loan, which is a better loan program all over. So yeah, that's pretty much what equity is. It is a benefit if you decide to use it, pull out, or if you decide to sell. When you go to sell your house, your real estate agents are going to let you know how much equity you currently have in your house and what you can expect to get back at closing when you do sell.
I think it's very important that the time that we're in right now, so many people are refinancing, right? So many people are pulling out that money. So to take your refinancing, when the refinance is done, how does insurance involve into that refinance? Do they have to get new insurance policies? Do they have to get like new pages? How exactly does that work? Because most of the time when they're refinancing, we're out of it, right? Because they're staying in their house, they're doing stuff to their house. But how do you guys work across the field in that space?
Well, with refinancing, the insurance typically stays the same. So we're just pretty much rolling over their existing policy into their new loan. I had one recently where their insurance premium was so high, I guess inflation. So I reached out to Brittany, I had her do a new quote and was able to get the person a lower interest rate. So not only is she getting a lower interest rate because she's refinancing as well as a lower payment, but her payment is also going down because her insurance went down as well.
Oh, they like you.
I know, right? I know, right?
Can you explain, you said the FHA is better than a conventional? I'm assuming that's gonna deal with PMI, so could you just talk about that?
Primarily has to do not only with the monthly mortgage insurance, but FHA also requires an upfront mortgage insurance. That upfront mortgage insurance premium is 1.75% of the loan amount, which can get costly. You can roll that into the loan. However, it's an additional fee that conventional just doesn't have. The downside of conventional, of course, is you need a higher credit score. And with conventional loans, the mortgage insurance is going to eventually fall off when your loan to value reaches 79%. FHA, it used to fall off, but it doesn't any longer, from my understanding. Now it's the life of the loan, you'll be paying mortgage insurance. Right. So regardless of equity, regardless of how much, you're just going to be paying it. So when I do discuss FHA loans with my client, I do tell them the long-term goal is always to get out. Is that bad to say?
But you know what? It's really good even for agents to know, because people will be like, "So what loan program am I going to get?" I do not know. I don't know, because I tell them, I'm like, "Hey, you have to go talk to your lender. Like, you have to talk to them. I can't tell you what loan program you are. Now I can ask you, like, have you ever been in the military? Oh, you have been in the military. That's cool. So you can use your VA loan, but also, once again, let's talk to the lender, because I know sometimes those things change as well, too, right? So what would be the benefit of a military member either using their VA loan and not using their VA loan, right? Because sometimes people will ask me that, like, I don't want to use my VA loan this time. What's the benefit if they don't use it? Does that make sense?
Well, I had a client who didn't want to use their VA because they wanted to save it to purchase something for a larger amount. So once you use your VA, it's going to subtract from the entitlement available. You can have 2 VA loans at once, but it's going to be based off how much entitlement is left for that second house. So if you're planning to do a large home purchase, then you may want to save that entitlement for this large home so that you don't have any down payment at all. But VA, to me, is one of the best loan programs out there. So if you do have that ability, I definitely will say go for it, unless you have a longer term goal that you need to meet why you don't want to use it at that time.
That's good to know, because I know a lot of people. So, I have clients who have turned their VA home, like the homes that they purchased with their VA loan, right? They have one in Tennessee, they got another one in Texas, and then they come here, they're at Fort Eustis, and they want to buy another house with their VA loan. How many VA loans can you have out at a time? Two. So if they want to buy one here, should they refinance one of their other houses and then get a VA loan here, or is that too soon having their credit pulled? Does that make sense?
Turn the camera back over. Hold on. Yes.
All these questions.
And that's actually what I suggest. I definitely suggest, especially if you are going to use your VA loan more than once and retain that home, to refinance out of it into a conventional loan if you can. That is going to restore that entitlement. You can only have 2 VA loans at once. You cannot get a third. So therefore, yes, it's best to refinance out, or you have to sell it. You have to sell one or refinance it into a conventional.
Now, I have a question it'll probably be for both sides, but when it comes to, I've had a lot of people ask me, like, hey, I want to buy a home and possibly turn it into an investment property. I want to turn it into a rental. I want it to be some passive income. So how does an investment, or if it's a rental property, how does that affect getting funding and then also your insurance? Because I'm pretty sure it could be possibly different, but we get a lot of questions. People want to buy a home, like, hey, I want to buy it, and I'm just gonna live in it and I'm gonna rent it out. But is there qualifications for that, or if they just want to buy a property just to be strictly rental, what is the financing like, and then is insurance different when it comes to having renters in your property?
Yes.
So I don't know whoever wants to answer first.
I'm gonna add another question to her question for you guys to answer, right? And also at the same time, when they do decide to make that an investment property, they lived in it, do they need to notify you guys that they're making it an investment property? Does their insurance change? We could talk investment properties all day long, because that's what people are doing so much.
I'll let you go first. I've been answering first.
I feel like I'm gonna, okay. Okay, so if you have a primary residence and you turn that into an investment property or rental, you want to notify your insurance, because that changes the whole policy. We would put you as a dwelling policy versus a DP3 is what we call a primary residence. And the dwelling, you wouldn't necessarily, main difference is you wouldn't need personal property coverage. If all your personal property is out of that house because you're not living there, you don't need all that coverage in place. And then we'll also add rental exposure for that policy. We would take a look at your personal liability, because you're not there, so you don't really know what's going on. So you want to make sure you have maxed out personal liability if someone gets hurt and wants to sue. A question we ask also when a property turns investment is whether you're going to require renters to have insurance to insure their personal property in the house. So personal property, if we were insuring any personal property, if you're leaving a washer, dryer, refrigerator, we would want to include a little bit, but we certainly would decrease your coverage not living there. So yes, to answer the question, sorry, that was a long-winded version.
No, it's okay, because insurance, not insurance, but investment properties are on the rise, so knowing this now works.
One of the biggest things for investors, because a lot of investors, what they do to limit liability is they'll start putting different homes under different LLCs, right? And so one of the things that you could do to sidestep that is to get an umbrella policy, right? So you have one policy that covers all of your properties. It'll cover up to, at minimum, $1 million in liability. So you don't have to have so many companies. So and the idea behind doing different LLCs for different properties is if someone gets hurt under this property that's owned by this LLC and someone sues, they won't have exposure to the other properties under other LLCs, which could be very strenuous and paperwork complications. So the one thing to, again, sidestep that, depending on how many properties you have, it may be a commercial liability umbrella policy or it could be a personal liability umbrella policy. But if someone gets hurt on one property, it'll cover you up until, again, a minimum of $1 million, doesn't matter which property it is. So that's something that for investors that I think every investor should have. Yeah.
And like, you really don't hear people talk about umbrella policies. Like right now we're living in the world of social media university, Google University, you know, we got all these Facebook universities and stuff, right? Which are great. But I think what's happening is not a lot of the information coming from the source, right? Coming from people who are in this day to day. You guys do this on a daily basis. And I think one of the things that everyone in this field right now is having an issue with is having to change that narrative. Like, we're having to educate someone who's been educated on Instagram Live, right? And we're having to, right, or on YouTube, or now we got TikTok, and we're.
They know. After they watch that, they know.
They know.
Right.
They are an expert.
Right.
They know
did not go through
exactly
any classes.
what the process
They
is.
took the license.
They have,
They did the study.
yeah,
They got all
they have all their
got
credit
knowledge,
hours. They
yes.
absolutely know.
They
They
don't need
know.
a they don't need a lender. They don't need a real
They do
estate agent.
CE. Oh my God.
Right. Let's not talk about CE. But that is so true, and it's just like, I feel like right now, like, that's our biggest like battle, right? That is our
importance of using a professional.
correct.
Absolutely.
Professional, and what value can I bring to you?
Right.
What
Right.
value is, my real estate agents, things that I don't know, bringing.
Right.
How can I add value to you? How can you add value to the client? Because we're all in the same boat here.
Right, especially like with the investment things. Everyone now is like, I'm just going to be a investor because I know I can be an investor because people don't have to have a license to do it. And I'm like, but do you know the process of this is not easy? Or they're working with a cash buyer who doesn't need a lender because they have the cash in the, in the capital, or things of that nature. I'm like, but that's not who we are. You can be an investor, absolutely, but sometimes you definitely have to do your homework and work with individuals who work in the field that you need them in.
Something that I see with a lot of clients, especially ones that want to purchase homes with cash, and they're like, oh, I don't need an agent. It's like, okay.
I don't need an agent. They also end up purchasing them without insurance. I've seen that a lot.
They don't need an agent. Little do they know that their level of negotiation skills are
Horrible.
not going to be there, which is what your real estate agent is for.
Right.
Following things by law, doing things legally, making sure that you're getting all the inspections that you need, using an insurance person that's able to give you the policy that is going to cover you sufficiently, using the professional to help you is extremely important.
I have 2 clients who went through YouTube University, right? And one went $80,000 over budget on a property, and now can't sell the property.
And if we had a real
I mean, if they had a real estate agent,
we would have been able to tell you that this is way
way
overpriced.
I'm telling
overpriced.
you, the comps in the neighborhood aren't going to work. You're not going to be able to sell it for that. As you
Right.
guys would be able to figure out. You guys can look at
Correct.
the comps and say,
Correct.
hey, don't put that much money into it, because if you're going to try and sell it right after,
It's not going to sell.
You're
for
not
what
gonna
you're
get it for that.
You're not going to want to sit
but
here
I
for
put
a
in
week.
brand new countertops.
Doesn't matter.
Okay.
I literally had a client tell me that they put in new installation. They were like, we put new installation up in the attic, and I was like, that's great. We painted. I said, that's great. We put new flooring in. That is wonderful.
You're still in the flood zone.
right.
You also live on a swamp.
Right.
Right. On a swamp in a flood zone. Like, that's
Because they
great.
didn't pull their flood cert.
Right.
Know that?
Right. And it really comes down to like knowing where to put your money, right? Like when I'm talking to sellers, they're like, I'm gonna do this, I'm gonna do that. Okay, you realize like when someone buys a house, it has to have flooring, right? Like if you don't have carpet in this house, it's very likely it's not gonna go VA, it's not gonna go FHA, right? There's messed up siding. Like you're putting your money in the wrong places. Like when you're these sellers, right? I see it all the time, and they want to go out here and outlandishly market their houses, and I'm just like, dude or gal, right? Or whoever, like you
Seller.
can't do this,
Right.
right? Like just because the house down the street sold for $25,000, the condition of the house is completely different than yours, right? We can't put lipsticks on pigs and then sell them for a steak price.
Very true.
Okay, maybe that goes to like my food analogies.
That's a great analogy.
I love it actually.
But I do have a question. So when it comes to investment, what's the financing like for investments? Do you guys do that? Or, how does it work if someone wants to get like a renovation loan with their loan because they buy a house and they need some work, but is that something that you guys can do for buyers?
Your interest rate on an investment property or second home is going to be higher. Typically speaking, the amount of money that you'll have to put down as a down payment will be higher as well. There are specific loan programs with different lenders out there that give you the option to maybe only put down 10% instead of the full 20. Recently, we've been seeing investment properties and second homes won't even receive interest rate pricing unless they're putting down 20%. We've seen them back off of that a little bit as we're coming out of COVID, and there are some products out there that will offer interest rate pricing with 10% down on a second home or investment property. But the interest rate on those will definitely be higher because typically speaking, when you're purchasing an investment property, you're making money off of that. So they're going to charge you more for that interest rate. So.
And also the interest rates are higher because investment properties are just more risky. It's more risky than the primary residence. Our second home interest rates are comparable to primary residence, but he is correct in stating investment properties, one, the interest rate is going to be higher. The down payment requirement is definitely higher. The minimum down payment requirement for us on a single family investment home is 15%. So those are things you have to consider. And then you also have to think that when you buy multifamily, the down payment is even greater for multifamily homes, a minimum 25% for two-family. So if you don't have a 25% down payment for a two-family home, then you may have to try to get creative with other financing options.
Even if it's primary, if that starts off at your first home, multifamily, you're one of the duplexes, someone's in the other.
So if it's your primary, I think it's 15% for conventional. With FHA, it's the standard 3.5%, but it's not for investments if you're going to occupy the property, yes.
So you can still buy a multifamily home as a primary residence and still get the first-time home buyers, if you are one, assistance.
Not the assistance.
Ooh.
So the FHA is 3.5% regardless.
Gotcha.
So you're not getting assistance with the down payment, so you have to pay that 3.5%. However, it just gives you, it's better than going conventional in that aspect. That's the only time I would say FHA is better than the conventional because the down payment is lower, and they don't care if it's a 3-family. I think it goes up to 4-family dwellings with FHA, yeah. And just to let you know, many people don't know with VA you have the same option. You can buy a VA home with no down payment that's a multifamily. Did you know that, Victoria?
I did know that.
Okay.
I did know that. And people do it all the time.
They do.
People do it all the time. Like I know, so back out in Tennessee, a lot of our, like the fourplexes and the duplexes and stuff out there were really, really huge. And it would always be like one unit was empty. And so actually there's an investor out there and he was selling all his units and he had 10 fourplex units. Out of those 10 fourplexes, I want to say like 6 or 7 of them were sold to service members and their families, and they moved in, like they all moved into one, but now when they leave out of there, like when they move from that duty station, they can rent them out too. But I think it's also important to state that if you are doing that, you have to physically live in the property. Like you have to live on the property, so you can't use your VA loan to go buy an investment property. You have to live in the property. a lot of people, you have to live.
Yes.
They missed that part.
It's your
You have to
primary
live.
residence.
Right,
You
right.
live there. You have
Well,
to
how
live
would
there.
they will find it, and they will find out if you don't live there. If you don't move in, what is it, 60 days? They have to
60
occupy
days.
within 60 days, right? So like, you have to move in the property in 60 days. If not, they will find out.
And that's called mortgage fraud.
Yeah, you don't want to end up there.
Woo. It gets dicey. It gets really, really dicey. So I have a question for our insurance agents over here. What is insurance scores? Like, how does that work? How does that come about? Probably in the past, I want to say 18 months, I have really been like, not trying to figure it out, but I've had insurance agents ask me like, hey, you know, we have to figure out what their insurance score is before I can give them a rate and things like that. How is that comparable to a credit score? What does that look like for you guys?
So we have a combination of your credit score, your previous claims are like the two biggest things, and what type of claims you had. So those three things kind of go into the mix of how that insurance risk score comes about. So it's a compilation of your credit score, your claims, and the type of claims. And I guess the frequency, right, would be what makes ours up.
Yeah,
Okay?
yeah. And that's a great answer. I have nothing to add to that. I mean, you hit every. Maybe the fact that, you know, like, I've gotten the question of, you know, will this impact my credit? You know, you're trying to figure out my credit score, your financial scoring. Some carriers rate heavier on your financial scoring than others. So if it's looking like we can get you a better rate with a company that rates that scoring, we'll definitely look into that. But it does not impact your credit anyway. It's a soft hit. I work primarily with lenders, so they wouldn't be referring clients my way if it was going to impact their credit and then risk, you know, a loan not going through.
That's
Agreed.
So, so I think one of the biggest things that's happening in our world today, right? We have a lot of entrepreneurs. We have a lot of self-employed business owners and things like that. When it comes to them buying a house, right, or buying an investment property, what does that look like? Like, I know that on the traditional sense, right, they normally have to have 2 years. Every time I've purchased a house, it's always been, hey, we need 2 years of your tax returns, right? Well, let's see, COVID started in 2020, so we're not even 2 years in, right? What does that look like for people who just started their business during that and they want to go buy a property, but they haven't been in business for 2 years? What is that? How? Because self-employed, it's a really big thing, and it's really coming back, and we want to make sure that they can get into a house as well. I think that's really important.
As scary as you might think it'd be.
Right.
You are allowed to be self-employed.
Right, you are.
You are, and you can purchase a home. It is not something that is unobtainable. Being able to show financial business stability over 2 years is extremely important. Specifically, I would be requesting 2 years of your tax returns, business and personal. If you are W-2, if you W-2 yourself through your company, through your business, we need your W-2s as well. We also require P&Ls. Most P&Ls are unaudited P&Ls. Oh, profit and loss. P&Ls. A profit and loss statement, or income. They're sometimes called income statements. And those income statements are year-to-date income statements. And then we would request 3 months of business bank statements as well. And that business bank statement and that income statement or profit and loss statement have to coincide. So as you're showing deposits into a business bank statement, your P&L has to reflect those deposits as well. The underwriter will compare a P&L with business bank statements. And if they don't match, they will consider those P&Ls to be unsupported. A lot of self-employed people will transfer money between their business bank account and their personal bank account, or personal bank account to a business bank account. And that can get lost whenever you're not accounting for those things on a P&L statement, a profit and loss statement. Depending on how long you've owned your business, if you've owned your business for longer than 5 years, your requirements for documentation can be a little less stringent, but anything less than 5 years, 100% need 2 years tax returns, 3 months business bank statements, year-to-date P&Ls, profit and loss statements. And if you are W-2 employee, your W-2s for the past 2 years as well.
So
Including all schedules and K-1s. So your business tax returns will have, they're long, they're big. There's a lot of things that come along with the
they're not
business.
nice.
They're long. I am learning. Are you good at tax returns?
I used to be an underwriter, so yes.
See, she's got
Yes.
one up.
I'm very good at it, yes.
Yes. So, no, that's awesome because it is. Tax returns get complicated with all the schedules and K-1s and different what information is on each one, and how am I going to calculate income off of these tax returns based off of these schedules, etc. So.
To go further into your question, Victoria, unfortunately, the answer is, unfortunately, you need to be employed or self-employed 2 years. We need to see that 2-year tax return. That's when we consider your income to be stable. You can have an amazing year in 2020. So trying to qualify you just off of 2020 wouldn't necessarily be an accurate picture because 2021 could be horrible. We need that average. We need to make sure that that the income has been increasing. If you have a decline in income, that can pose an issue. Unfortunately, 2020 for some people may have caused a decline. So I'm saying where we're not able to do loans for that reason is unfortunate. The profit and loss statement typically is done by an accountant. My company doesn't necessarily compare bank statements to the profit and loss because we're going by the word of the accountant that prepared it, that he did his due diligence and reviewed all income documentation to support whatever he's putting on that paper. But each company has their own different guidelines.
This is so interesting.
Right.
It really, really is. It's, the main idea of bringing everyone here today, right, is to show that we have to work together throughout our business, right? I can't sell a house without either one of you, right? It takes everyone to work together, and I think so many people don't realize that, especially when you have people going to buy houses without an agent. Oh, I don't need a real estate agent to buy a house. I'm just trying to figure out how you're going to do this, right? Because in the state of Virginia, it's a buyer beware state, right? So with it being a buyer beware state, if that buyer doesn't do their due diligence, whether it's on the financial side, the insurance side, they're up the paddle, like up the street without a paddle. I think that's how that phrase goes. No, I said up the street, up the creek without a paddle.
Right, I'm like, okay,
Yeah,
we'll do it,
Yep, we'll do it.
That's why we have flood insurance,
It's okay. That one definitely got butchered.
It's okay.
But it's also really, really important. And I'm so thankful that all you guys took the time out of your Saturday, where you could be with your families, you could be working with other clients, just to come educate us, just to come and not only educate us, but educate, our guests, educate the clients, our future clients that are coming to see us, especially moving into a space where we have all these wonderful universities online, educating people. So I just really would like to say thank you. Thank you so much. I appreciate it.
Yes.
Of course.
A ton.
A ton.
I know about you
Serious.
guys, but I
never
really did.
stop learning, especially on the insurance side, because I am the first person to say when people start asking me insurance questions, you're gonna have to call the insurance person because it gets tricky. I've never in my life thought about if someone has a bunch of diamonds in their house that their policy needs to be higher.
Right.
It makes sense, but I personally have never thought of that.
Yeah.
Vice versa. We get lending questions, I'm like, I have no idea. But I can put you in touch with someone that does.
Right. Because I know my insurance, so I do have guns in my house. I know my insurance agent asked me when we were buying our house, so do you have guns in your house? And I was like, yeah. And she's like, okay, so this needs to be your insurance for that. And I was like, okay, wait a second. there's more insurance.
And that's
Like-
a personal articles policy.
Yeah, like she was like, you need to have this in case, you know, someone gets into your gun cabinet, in case someone gets, you know, gets hurt by yours or whatever. And I'm just like, well, you know, ours stay locked up. And she's like, that doesn't matter. Like if someone breaks into your house and takes your gun, like you need to have insurance on that. And then like, they're like, you know, what's your serial number? So what's this, what's that? And I was like, wait a second, this is a lot.
Yeah.
But it's so important to have too.
Yeah.
So yeah, no, this has been so great. I'm
has.
so excited.
Agreed.
Thank you for having me.
Absolutely, and hopefully we'll be in touch, you know, of course, with clients. So we
Y'all
can see
know
more
me.
of you
I'll
guys.
shoot a text message. Y'all know me. I will shoot a text. So what is this answer?
Right. Like, hey, I have a question here. Is this the right person I'm reaching out to? Is this your question? You know, can you get this answer for me? But we definitely do appreciate you guys and, you know, our reliable resources. So we thank you so much.
Thank you. Thank you.
Yes.
And I just want to shout out the man behind the camera today, Mr. Henderson, as well. Thank you so much. I appreciate it. So yeah. So thank you guys.
Thank you.
Hey, my name is Shakira Grant. I am a realtor here in Hampton Roads. We just finished our home ownership panel, and I would say I've learned so much today. We had some really great questions. I learned so much about the lending process and insurance process that I didn't already know as being a realtor, because of course my hat is a realtor hat. But yeah, I had such a great conversation. I hope you guys learned so much from this video as well. If you have any questions, please reach out to me. Follow me on Instagram. It is shakira.therealtor. If you have any questions, send me a message. And hopefully we'll be able to see you guys at our next discussion, because we will have another one soon. You guys be blessed and have a great week.
All right, I am Jared Hunt. I am a mortgage consultant at Dolphin Home Loans. I could not be happier to be here today. I am always willing to learn and learning new things every day. Our panel discussion was amazing, and the feedback that we receive on all sides of the home buying process is important. So you can reach me. My website is jhuntmortgage.com. You can also follow me on Facebook, Jared Hunt, Loan Officer, Dolphin Home Loans. And my phone number is 850-974-4599. Thanks for having me.
So my name is Victoria Bailey. The conversation today was absolutely amazing. I'm so thankful for all of our panelists and our guests that came out. The conversation is just about home ownership, from self-employed to being employed, just the different things that we use and how we connect together to help you get to your home ownership goals is really what I wanted to convey, and I felt like it was great and it was amazing. So if you guys have any questions, my name is Victoria Bailey. My number is 757-472-7355. Shoot me a text or give me a call. Look me up on social media, Victoria Bailey, Realtor. Bye, you guys.
Hey, my name is Dejan Briggs. I'm the owner of D. Briggs Insurance Financial Services. I so enjoyed my time here today with this panel. I hope you guys were able to take away the initial steps and the subsequent steps to making your home buying journey a complete success. If you would love to get in contact with me, my number is 757-978-3282. You can also get me online at dbriggsfinance.com. Shoot me an email at dbriggs@dbriggsfinance.com. I look forward to serving you all for many years to come.
My name is Sareva Manuel with Homespire Mortgage. I am a senior loan officer.
I'm Brittany Watrous with Goosehead Insurance. I'm an account executive.
We were at this event today. It was absolutely amazing. We got to meet with different lenders, insurance agents, vibe off one another. My takeaway was different things I didn't know about insurance, the different things you should have covered. So thank you, Brittany.
Yeah. And my takeaway is how imperative it is to work with a lender, a real estate agent, insurance agent. We have one team, one great
Yes,
team here.
absolutely.
We'll always give you the best options for loans, mortgages, and then insurance, finding you a great rate. So I look forward to working with all future clients. You can reach me on my cell, 757-285-7865.
And my cell phone number is 757-502-5447. I also have Instagram, Simply Amazing LO for loan officer. I'm your Simply Amazing loan officer. So you can reach out to me there. But we both look forward to helping as many people achieve home ownership as possible. So please contact us today.
Yep, looking forward to working with you guys.